In this video, I want to consider the characteristics, the features of municipal bond. As a beginner, I want to really take time to highlight what this type of bond is all about. So, my one feature here is the issuer. The issuer. This bond is issued by state or local government or their agencies in Nigeria here, in the US, and in other countries. They are issued by the local government, by the municipalities, or by the state government. Number two is the purpose. So they are used to fund public infrastructure projects or community needs, such as roads, schools, hospitals, or utilities. Construction of public interest actually are funded by municipal bonds. Number three is tax advantages. This that the interest income is often exempted from federal income tax and may also be exempted from state or local taxes if the bondholder resides in the state or locality where the bond is issued. If the investor is a resident in the state where the bond is issued, then the individual concerned, is will be exempted from the relevant taxes when it comes to our municipal bonds. Number four is low risk nature. Generally, speaking, that's lower risk than corporate bonds, but there's a higher risk than the bond issued by the federal government or by the Nigerian government or by the US Treasury, as the case may be. So the risk is there, but it's generally low. So the risk depends on the financial health of the issuer. If the state government is doing very well, then the risk involved will be quite minimal. But if the government is struggling, the risk involved, the risk associated with that kind of bonds could be relatively high. It all depends on the financial condition of the issuing government. Number five is types of municipal bonds. Types of municipal bonds. There is general obligation bonds, which are backed by the issuer's tax-paying power. There's also revenue bonds. These are backed by revenue from specific projects, and equally have special tax bonds. These are secured by specific taxes like sales or hotel taxes. So when it comes to the general obligation bonds, the investor is paid from the taxing power of the government concerned, at whatever they can generate in tax. Then of course they will use it to pay the bondholders. The other one is revenue bonds. These are backed by specific government revenue. So they derive revenue from this project sponsored or funded by the bond. Then the bondholder will get his coupon from the revenue generated from those projects. And when it comes to special tax bonds, you have special tax like taxes from hotels, from related businesses. So whatever they realize from those businesses are paid out to the municipal bondholder. Number six is interest rates. That's the coupon payments here. So they pay periodic interest, typically semi-annually, with rates influenced by credit quality, market conditions, and duration. Generally, in the interest rate, the coupon in bonds, are influenced by the duration of the bond. Not only that, by the quality of the issuer. If the issuer has the financial standing, the right financial standing, Then of course the coupon rate will be a bit lower. But if the issuer is struggling financially, they may offer a higher coupon rate, but the default rate is equally high. So it's left for you to be able to balance what you're looking for. If you can bear the risk at the higher coupon rate, fine. If you cannot bear the risk, you will go for bonds that gives a lower level of yield, but with a stability, and you don't need to really bother about the issuer defaulting. Number 7 is a maturity. So when it comes to maturity, it ranges from 1 to 5 years for short-term bonds, 20 to 30 years for long duration bonds. You equally have callable bonds, which may allow the issuer to repay before maturity. When they say bond is callable, it means that the issuer of the bond can call back the bond, so to say. You will be giving you back your capital before maturity. Let's say a bond is built to mature in 5 years. Probably after 2-3 years, the government may call in the bond and then give you back your money, your capital. That is callability in this regards. There is this issue of credit ratings is very, very important in bond investment, but that will determine the suitability of a bond for certain kind of investors. And so they are rated by agencies like Moody's, like Standard and Poor or Fitch. So a higher rating like AAA indicates lower risk, while a lower rating suggests higher risk and higher yield. Usually the more risky a stock is, the more the yield. A bond is. The more risky a bond is, the more the yield, the kind of payout. So it's left for you to decide what you want. If you can stomach the risk, you have the risk appetite, you could go for the bond with a higher level of risk. It all boils down to your nature when it comes to risk tolerance. Please subscribe to this channel and like this video. Number 9 is market price volatility. Market price volatility. So price fluctuates based on interest rate changes, credit quality and economic condition. These are the factors that affect bond price. The condition of the economy affects bond price. The interest rates equally affects the bond price, as well as the quality of the issuer. If the issuer has the right financial standing, then of course that will equally affect the expectation of the investor from that bond. And of course, this also has to do with these factors equally affects the fluctuation of the returns from the bond in question. Number 10 is accessibility. It's available to virtually, they're available in different denominations, making them accessible to both retail as well as an institutional investor. We have 50,000 naira you can key into this kind of bonds, with as much as any amount you can equally key into it. So the retail investor can participate, and the high net worth individual can equally participate, and institutional investors can equally participate. So this is highly accessible to different types of investors. Number 11 is liquidity. It can be traded in the secondary market, though liquidity may depend on the bond type and the demand on those bonds. These are the factors that control liquidity. What is the type of the bond, the class of bond, the type of bond, as well as the demand. If the demand is high, then liquidity will improve. But if the demand is low, you have a lower level of liquidity. Number 12 is default risk. Rare but possible if the issuer faces financial difficulties. Revenue bonds tend to have higher default risk than general obligation bonds. When it comes to revenue bond, the government depend on the revenue they could get before they can pay their bondholder. If the revenue don't really come in as expected, that will affect what the bondholder will get. That will even lead to a default if care is not taken. Number 13 is social and ethical investing. It's often attractive to investors who are seeking to support the local or community development project. If you're the type that, apart from looking for profit, you equally want to see how you can use your investment to support the local community, then municipal bonds is a very good candidate for your investment capital.